The last and final piece of Chapter 16 brings all of the financial statements to a culmination for the end of the fiscal period. So this is a great time to review the entire accounting cycle for a merchandising business that's organized as a corporation and see how it all fits together. So from the time a transaction happens, there's always going to be a source document, a check that was written, an invoice that was sent, a debit memorandum, a receipt. This is where it all starts. Once those source documents are there after a transaction, then the transactions need to be recorded in the journals, either the general journal or one of the 4 special journals: sales, purchases, cash receipts, and cash payments. Then those journal entries are posted to the accounts payable and the accounts receivable ledgers and the general ledger. So just a reminder, accounts payable ledgers are vendor accounts. You bought something from someone and said that you would pay for it later. The accounts receivable ledger is for money that you are going to receive for purchases that others made of your business. And then the general ledger is all other accounts for rent, for supplies, and those types of items. Then you create what are called the schedules of accounts payable and accounts receivables, are prepared from the subsidiary ledgers. The subsidiary ledgers are your vendor and your customer accounts. And you create basically a list of all of the balances, and that is the schedule of accounts payable, and also then you have a schedule of accounts receivable. The 5th step is that there is an unadjusted trial balance that's prepared from the general ledger. The adjusting entries are journalized. So these are times when, let's take for example, supplies. So at the beginning of the month, they had a supply values of $6,000, but by the end of the month, they have a supply value of $2,000. That means that they adjust the entry by $4,000 because that shows how much they used. Adjusting entries are then posted to the general ledgers. An adjusted trial balance is prepared from those general ledgers. Then we have the financial statements, which we've been focusing on during Chapter 16. Then you have the closing entries, which you just did in the last section of Chapter 16. And the closing entries are then posted to the general ledger. And then a post-closing trial balance is prepared from the general ledger, and that is what we are doing in this section. So let's back that out and let's go back. So we're going to prepare a post-closing trial balance. So the general ledger, after closing entries have been posted, so you have your general ledger accounts, and then you're going to use those to prepare that post-closing trial balance. So let's take a look at what types of accounts are on this document. So the accounts with any balances. So if you remember earlier in this chapter, we dealt with the temporary accounts, which were all of your expenses and revenue. So those have all been zeroed out. They no longer have any balances. So the only thing that goes on the post-closing trial balance are accounts that still have balances. These will typically be your asset accounts, all the way down to here, and then your liability accounts, all the way down to here, and then your equity accounts, which are capital stock and retained earnings. They are going to be permanent accounts, and they are going to continue to have a balance. And that is what goes here. And then the final sum of each of these columns, of the debit and credit column, should match. Therefore, you see your accounting equation is balanced. Your asset accounts, all the way down to here, okay, they are equaling the same thing as your liability and your equity accounts. So the account balances, the totals, column totals, and you double rule to say, we're done, we've closed this book, the books on this for this fiscal period. Very, very simple. All right, so we went through this earlier, so we're going to fly through it again. All right, what accounts and balances are listed on a closing trial balance, and in what order are they listed? The general ledger accounts that have balances, and the accounts are listed in the same order as they appear in the general ledger, which is going to be assets, liabilities, and equity in that order. What is the purpose of preparing a post-closing trial balance? Well, the purpose is to prove the equality of your debits and credits in the general ledger, saying that the accounting equation is balanced. What two steps in the accounting cycle occur after adjusting entries are posted to the general ledger? An adjusted trial balance is prepared, and then the financial statements are prepared from the adjusted trial balance. All right, that is short, and this work together is pretty easy as well. So we're going to move right into that right now. All right, so moving into 16.5 work together. You are given all of the accounts that have balances. So this is pretty straightforward and extremely simple. So the first thing you're going to do is you're going to put the name of the company in the heading, the name of the document this is the post-closing trial balance, and the date is December 31st. So that is what your heading is going to look like. Then you are going to proceed putting all of these accounts in and putting the balance in the correct column, whether it's a debit or credit. Now you know that cash, petty cash, and accounts receivable are all asset accounts that increase on the debit side. So I'm just going to scroll down here and let you see those. But then we see the allowance for uncollectible accounts. And this is an asset account, but it is an asset account that decreases. So this is going to be a credit. So let's just keep scrolling. So there you can see it. Then we're going to continue with merchandise inventory, supplies store, prepaid insurance. And now we're moving into our liability accounts. And then you're going to simply total those. And if the numbers do not match, you know that you have an error. You likely put something in the wrong column, or you had some other kind of error in your calculation. But this is very simple. All you're doing is taking those balances, putting them in the right order, and then putting them in the correct column, whether it's a debit or a credit. Okay? So again, asset, 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 but this asset reduces the value of the assets, so it's a credit. Asset, asset, asset. Now we're into our liabilities, and now our last two our accounts are our equity accounts, and they increase on the credit side. And our assets equals our liabilities plus our equity. So we are finished with the work together. So go ahead and finish that, and then do the on your own.